Stocks had an exciting week as we went from everything bubble to everything crash in about a day and a half, with gold and silver loving every minute. So what just happened? In case you just woke up, stocks crashed on Tuesday. Monday was a holiday, losing 870 points on the Dow. Mainstream media blamed Trump's tariff threat over Greenland, but thanks to Bitcoin, which trades 24/7, we can actually go to the tape. Turns out Greenland barely made a dent. What caused the bloodbath was Japan. Specifically, Japan's new Prime Minister Takaichi announcing a raft of reforms to slash taxes and hike government spending on the most indebted nation on Earth. This sent Japanese bond yields, interest rates, soaring as bond investors worry that Japan can't handle its debts. The problem for U.S. markets is that Japan has something called the carry trade, where hundreds of trillions of yen stand borrowed by overseas hedge funds and speculators in a free lunch funded by the Bank of Japan, their Fed. So soaring Japanese bond yields crush this trade, which can set off a global rush for the exits. So Japan's original sin is when their easy money bubble burst back in 1990, instead of letting weak companies and banks die off, they put them on permanent life support with stimulus and low interest rates. This created a zombie economy of money-losing companies that hog up a third of all bank lending, and almost 10 million Japanese workers essentially paid to lose money. The result is while American productivity grew by half since 1990, Japan's actually dropped, translating into real wages that are lower in Japan than they were in 1990. And also driving Japanese government debt to 230% of GDP, which is about $70 trillion in U.S. terms. To finance all that debt, the Bank of Japan pushed interest rates near zero for around about 30 years, which you have to do because otherwise the debt interest will eat you alive. But this created the free money machine of the century, the yen carry trade, where overseas hedge funds and speculators borrow yen at zero, and then they put the money into U.S. assets, paying 5% bonds or 8% stocks. So borrow at zero, invest at 5 to 8. Thing is, this works only if Japan's rates stay low and the yen stays weak. So the low rates are the juice, but if the yen gets strong, the yen debt outgrows the dollar investment. You're underwater. So when Takaichi's presser sent Japanese bond yields soaring, that sucked the profit out of the carry trade, which kicked off an unwind, which actually makes the yen stronger since they dump assets for dollars, then they have to dump the dollars to buy the yen to repay the original loan. So you're dumping dollars, you're buying yen, the yen goes up. Suddenly the free machine goes in reverse, you get a rush for the exits and 870 on the Dow. So it's next brought to you by I Trust Capital. The carry trade is the fentanyl of the financial world. But Japanese yields create an even bigger risk because they blow a hole in the Japanese banks and pensions whose vaults are full to the brim of Japanese government debt. We actually got a taste of that here in 2023 when the Fed hiked rates and a series of banks collapsed. That happens in Japan. The institutions will pile in with the carries to dump overseas assets, which are overwhelmingly American assets. So Japan is the single biggest holder of U.S. federal debt. Toss in Japanese banks and pensions, and they hold over $3 trillion of American assets, ranging from stocks to corporate bonds to U.S. treasuries. 40 years of economic mismanagement has brought Japan to the edge of Argentina. The blowback will go worldwide. Read the rest with charts and all the gory details at profstanonge.com. Okay, we'll be watching. See you next time.